Hi, welcome to the Numerics Video Blog. I'm your host, Jim Jockel. Joining me today to continue our conversation on quantifying transformation, Paul Rawati, Director of Research at Alphacution. Paul, welcome back.
Thank you, Jim.
So we started into the conversation as it relates to the definitions of transformation, some of the work you've been doing, thinking about how to quantify that. Interesting at JP Morgan Chase in its highlighted its commitment to technology in its annual investor briefing a couple of weeks ago, citing a $9 billion tech budget, with almost 1/3 of that being dedicated to investments in other technologies. In terms of, obviously, as we saw in the journal, JPM too big not to fail, but what are other institutions doing, or how are other institutions thinking about this as they're going through their own tech transformation?
Well, I'd say in the one case, JP Morgan would be one of the leaders in terms of the mega big banks that have somewhere in the neighborhood of 250,000 employees. So, they're among a small set of global leaders, global banks that have the full spectrum, sort of the financial supermarket, that has culturally gotten to this point where they're, I would say, a step or two ahead in terms of integrating, having contiguous or organized backbone that allows them to launch products into different business segments. And then at the other end of the spectrum, you have the laggards who are still trying to figure out how to make decisions. And I think that really comes down to, at least the bet that I'm making in the research that we're doing at Alphacution, is that you need better tools for measuring what you spend, what are the spending patterns, how does that impact your decision making, could you use this output and these analytics to make better decisions, or to compare yourself and benchmark yourself to some of your other peers.
So some of the costs are obviously human capital.
Yeah.
Ballooning hardware costs, software costs, as well as the investments. In terms of that breakdown, any trends that you're seeing in some of the institutions that you've been looking at?
Yeah, so I would say, and we're just on the verge of releasing some new research here in the next month or so, hopefully early May, where we're taking our existing composite model, which currently includes, I believe, 58 of the largest banks in the world, all the G-SIBs, all the primary dealers, most of the top 50 banks, and a few of the top 100, in the second 50. We're actually getting estimates because of the human capital that's dedicated to IT, because more and more banks are creating what you would call either a infrastructure segment that they report in their financials, or what they call maybe a corporate center that includes all their enterprise risk, which you know about, their enterprise operations, this layer that is more horizontal as opposed to the verticals of the different, the wholesale banking side, the retail banking side, the insurance, and the wealth management. So what we're seeing in terms of the trends in your question is software has been the most high growth area of that triumvirate if you're looking at the human capital piece, the hardware piece, and the software piece. Of course, software is unique because it's got a lot of capitalized human capital. It's really a human capital expense, but a human capital cost that is amortized and that you can capitalize. That piece has been growing the most relative to the others because of regulatory drivers, and there being no off-the-shelf solution for an enterprise GRC, enterprise governance, enterprise reporting. So that's the most notable, and I think secondary to that is therefore the crowding out of hardware spend, which causes, almost by default, an unintended tipping point into new infrastructure as a service, because if your budgets are relatively inelastic and more of it is sucked up in software development expenses, that leaves less for infrastructure, which forces you to try and adopt cloud and other hybrid and other infrastructure as a service even faster than you might otherwise, because you have to do the software, you have to do the reporting.
Thank you, Paul. And we're going to continue this conversation in just a few minutes.